Today, we're going to talk about one of the ideas that we own with a lot of conviction, and we believe it's a structural growth story. I'm going to talk about Titan, and we have our own in-house investment framework known as the DNA test, where we look for companies who stand tall on our DNA grounds, and we also look at how their growth trajectory and valuation trajectory is evolving dynamically, and therefore we call it the DNA positive test. So we look at 5 key parameters on any stock that we decide to go ahead and invest in. The first one is a durable growth opportunity. The second one is a noticeable right to win. The third one is ACE governance. The fourth one is visible superior growth, and the fifth point is economical valuations. So why do we want companies that we invest in to have a durable growth opportunity? Ideally, these companies provide you a structural growth story, and these are not cyclical or tactical in nature. They grow for a very, very long period of time. And in Titan's case, the big story here is the share of organized retailers in jewelry is still sub 5%, and therefore the runway of growth for Titan in the jewelry market is very, very huge. Secondly, we also believe with Titan entering newer categories in women's bags, women's saris, eyewear, smartwatches, wearables, etc., that with the new product expansion, there is a lot of runway for growth in terms of category expansion and gaining market share from other smaller unorganized players. So we expect a 7-fold increase in its Mia range of handcrafted jewelry from 3 billion rupees in FY22 to roughly 20 billion rupees in FY25, which meets the criteria that we're looking for of a durable growth opportunity across categories. Secondly, the retailing vertical with the brand Zoya is expected to grow 4x in the same period, but the base is really small because it's a new venture by Titan. Thirdly, even in the online segment, Titan is consolidating its presence with the acquisition of CaratLane, which caters to smaller ticket size jewelry items. We've seen a 37% growth between FY17 to FY22. And we also expect that the store count is going to double in the next 2 years. Whether we talk about now the eyewear category, I think that's been a loss-making business for Titan so far. But we are seeing that the intensity of losses is coming down sharply, and this venture should also turn profitable in times to come. And management is also guided that the jewelry business must be at least 2.5x of what it is in the year FY22 by FY27. So in terms of the size of opportunity, we believe Titan meets the criteria that we're looking for in terms of profitable store expansion, benefiting from the whole parentage of Tata Group, and the benefit of hallmarking in the organized category, which puts Titan in a league of its own. We also believe that the category that Titan operates in is less prone to disruption by the online retailing market as maybe fashion probably is or grocery is. So we believe the high ticket items such as jewelry, which are also high ticket, high value and involve a high amount of personal touch before making the purchase decision, are less prone to online and digital disruption. The second thing we really look for while evaluating a business is a noticeable right to win. Titan is the largest wristwatch company with a 60% market share in the organized market in India, and it is also the 5th largest watch brand in the world. In terms of jewelry market, it has a 41% market share in the organized segment. The reason why Titan can do so well in the jewelry market is because it's a business of trust, and with Tata Group's strong parentage, brand equity, and financial power, we believe Tata has put Titan in the right category with the right parentage, making sure that customers continue to trust the Tata brand in terms of their ethics and integrity, to make sure that the customers are treated fairly. And given jewelry is a segment where the margins tend to be very high, also fraudulent transactions tend to happen in the unorganized segment in terms of quality of the items being sold. hallmarking has put Tata and organized jewelry segment in a different league altogether. And as a structural trend, we are also seeing that the unorganized players are losing market share because of things like GST, COVID, cash crunch, working capital requirements, etc. And given the strong balance sheet and cash positions of Titan, it will really be able to consolidate market share at a much faster pace. If you look at a 15-year, 16-year period, Titan has consistently grown its revenue at a CAGR of 23%. And finally, when we talk about governance, I don't think Titan deserves much of a conversation here, given it is a Tata Group company and has superior return ratios, and it has a net cash positive balance sheet over time periods. So I don't think governance is an area of debate when it comes to Titan. And lastly, we also need to look at the near-term growth visibility and valuations. So in terms of near-term growth, we definitely see an 18 to 19% EBITDA CAGR and a 22% sort of profit CAGR for Titan between FY22 to 24, which we believe is very, very healthy, given it's north of its peers, north of the broader markets itself, and north of the broader Indian economy itself. And lastly, we look at valuations, and we must understand that in terms of valuations, we need to look at cash flow yields, return on equity, and the growth trajectory of a company to decide if it is really reasonably valued. Because say Titan at a 45 PE might be cheap, and a textile company at a 15 PE might be expensive. So PE on its own is not really relevant here. What we believe is relevant in valuing companies is how do you gauge the valuation multiples relative to its ROE, relative to its cash flows, relative to its growth trajectory. And Titan stands strong on all these three within the consumer universe of stocks in India. I think on a 2-year basis, Titan has an extremely high free cash flow yield compared to peers even such as DMart, etc. So given the very high free cash flow yield, which is north of 10%, ROE is consistently north of 20%, and growth trajectory again north of 20%, we believe the valuations for Titan are fairly justified, even though optically they might look slightly expensive.